Hey there, traders. Welcome back to Still Capital. Today we'll be going over the famous ICT Judas swing strategy. We'll be showing you how to use it, when to use it, and how to use it best. So we'll first be going over entry criteria, then we'll move on to some examples that I took of the ICT Judas swing. So let's get straight into it. So first things first, the ICT Judas swing is a strategy that is used during the New York session opening range. So where the name Judas swing comes from, we're not entirely sure, but I'd assume it has something to do with Judas from the Bible, in referencing that the market makes a fake move first, or fools everyone to believe that it's on their side, then switches up direction and goes the other way. So that's my interpretation of the Judas swing. So we trade the Judas swing on two assets. We're going to use NES 100 and SPX 500. These are the two assets where we are going to trade the Judas swing. We can use US 30 for confluence, but these two are going to be the indices we take our entries on. So now our entry requirements. The first entry requirement that we have is that we want a liquidity sweep. After we have a liquidity sweep, we want to see SMT divergence. After SMT divergence, we want a market structure shift in the opposite direction. And if you do not know what SMT divergence is, you can go check out my previous video on SMT divergence, link in the description. So after we have our market structure shift in our direction, we're gonna look for one of these PD arrays. So the first one is a fair value gap, second one is a breaker block, third one volume imbalance, fourth one order block, and a balanced price range. So these are the PD arrays we're going to be looking for once we have a market structure shift. So we take our trades after 9:30. Okay, so let's assume that on the left we have NES 100, on the right SPX 500. So NES 100 makes a consolidation in London, in Asian session I mean. Then London session comes and sweeps the Asian session. Then comes the 9:30. So price hits the 9:30 open. And let's assume we have the exact same movement for SPX 500, as they are strongly correlated assets, so they move very similar. So once the market hits the 9:30 open, the New York Stock Exchange open, for Nasdaq, the market makes a lower low. But on SPX 500, the market can't make a lower low. The market instead goes up immediately. So what we have on NES 100 is that we have a liquidity sweep here. But on SPX 500, we do not have that liquidity sweep. So that would be the liquidity sweep, and the fact that we didn't sweep liquidity on SPX 500, that is going to be our SMT divergence. Since NES 100 made a lower low, but the SPX 500 failed to make that lower low. So we have our SMT divergence. The next rule is we want a market structure shift. So let's assume that after price makes that lower low, it moves up. Once the market gives us this move going up, we have a market structure shift here, because we took out an old high. So that is our market structure shift. On SPX 500, we'll probably have a market structure shift as well. But we focus on the asset that takes out liquidity first. So once we have the market structure shift, we take our our rectangles, we mark out our breaker blocks. We mark out our breaker blocks, and we mark out our order blocks, whatever PD arrays we have. So let's say we have a fair value gap and an order block here. What we're gonna then wait for is for the market to come back down into our order block or our fair value gap. So the market sweeps liquidity, makes a market structure shift, and comes back to our fair value gap and breaker block. This right here is where we take our entry. So if you look on both assets, we will have the exact same thing happening, but we take our entry on the asset that went lower first, meaning we're going to take our entry on NAS 100. So we're going to take our entry here, and we're going to have our stop loss behind the last candle of the fair value gap. If there's a fair value gap here, we're going to use the previous candle's low as our stop loss. I will show you on the charts how it's done. And our target, we are going to target the next external liquidity. So let's just assume that before price got here, yesterday there was a previous day high over here that the market made. We are going to target that previous day high. And this is how we use the ICT Judas swing. It's a really simple strategy. It might not make sense now, but once we get into the examples, I'm sure you'll understand how it is done. So let's go over to my journal. Okay, so now we're in my Notion journal. I'm going to show you a few examples of the Judas swing that I've taken myself. So let's look at the last 2 weeks of May. So this is May. I took this setup on the 24th of May. This is a Judas swing setup. I took this on NAS 100. The 9:30 open starts by this gray line. Where you see the chart start to get darker, that is where the 9:30 open starts. So we had the 9:30 open, price went down and went up and created a higher high. So it swept this liquidity over here. And then price went lower, then made another higher high. So if we look at SPX 500, what we'll see is that on that same day, the market didn't go higher. Instead, SPX went and made a lower low. So that would have been our SMT divergence, which you can see I have marked out by the line SMTES. So we waited for price to give us a market structure shift over here, which it did. We marked out our fair value gaps. There was a tiny fair value gap over here. And when price came back, I got my entry there with my stop loss just above the candle creating the fair value gap. And my take profit was somewhere down here. I used a trailing stop loss, so I got off quite at the end of the move. So that was the 24th of May. Let's go on to the next example. This was on the 29th of May. Another example of SMT divergence. So the market opened here. The 9:30 opened over here in the gray section. We went lower, went higher, then went lower again. So we made a lower low and we swept this liquidity over here that we had just made. So if we look at US 100, NAS 100 here, is that at that exact same period here, we had made a higher low. But on SPX 500, we had made a lower low. So what we'd want then is for a market structure shift. We went up here higher than this high over here. We marked out our fair value gap. And when price came back, we took our entry at the fair value gap. with our stop loss behind the candle of the fair value gap, the candle before the fair value gap. Our take profit was a high at the top, which we reached. I used the Fibonacci tool as my target here. So that's how I took this trade. Let's go over to the next example. This was on the 26th of May, an ICT Judas swing setup as well. So let me show you guys what happened here. So the market opened here at 9:30. The market went low a little bit and took out this small little liquidity that we had here on SPX 500. But on the Nasdaq, we did not have that liquidity sweep. So let me show you Nasdaq. Nasdaq did not have that liquidity sweep. Nasdaq went higher instead of lower. So on SPX 500, we were going to wait for a market structure shift, which happened over here. We're going to draw out our fair value gaps and our breaker blocks. So as you can see, we marked out the breaker block in gray and the fair value gap in blue. And when price pulled back to that area, we took our entry at the breaker block with our stop loss one candle behind the fair value gap. So this was the fair value gap. The candle before that low was our stop loss. And we got out at the top of the move using a Fibonacci extension. This was on the 30th of May, Judas swing setup. We made 5R on this particular day. So let's look at what happened. So this is NAS 100. We had the 9:30 open here. Market went lower, then went higher. So you might be wondering how we use the SMT divergence. If they both go lower, it does not count. We wait until there's a difference. So in this scenario, when NAS 100 went lower, SPX 500 also went lower a bit. So we waited till NAS went higher. When NAS went higher, that was our liquidity sweep over here. And that gave us our SMT divergence since NAS went higher and SPX went lower. So that's SMT divergence. We waited for a market structure shift. So here we used a different type of market structure shift. We did not use the previous low, we used the low we created. So when the market went high, it created this low. Then it went down here, creating this low, had a small push up, then went lower again. So that was our market structure shift over here. And we had a tiny fair value gap over there. So when price came back to that tiny fair value gap, I took my entry at the fair value gap with my stop loss behind the fair value gap candle. Okay, so this was on the 31st of May. This is an example that we lost. Just want to show you that the strategy does lose. So we have SPX 500 here. The market opened and pushed high. So we look at Nasdaq. Nasdaq pushed high as well. So we want the difference. We wait till SPX pushes lower and Nasdaq didn't push lower. So that would mean this is our liquidity sweep and this is our SMT divergence. So we wait for market structure shift. The market moved up, gave us our market structure shift. Then we marked out our PD arrays. I used the fair value gap in this scenario, which was over here. The market came back to our fair value gap, tapped our entry, pushed up about 2R, but I did not trail my stop loss in this scenario, as I only trail my stop loss after I take out a previous high. So the market ended up reversing and going to hit my stop loss. This is another example on the 31st of May. This is an example on the 7th of June. The market on SPX 500 went high on the 9:30 open. On Nasdaq it also went high. But then if you look closely on the SPX 500, is that it went high, low, high, low, high. But on Nasdaq it made a high, low, and failed to make another higher high. So that would have been our SMT divergence. So we have the liquidity sweep over here, and we have the SMT divergence. So we wait for the market to go lower, which it did. Then we want a market structure shift, which we got. We mark out our fair value gap, our breakout block. When price comes back to the fair value gap and the breakout block, that is where we take our entry, like in this scenario. So this was our entry. Our stop loss was one candle before the previous fair value gap candle, and we targeted the low over here. I got out by the Fibonacci extension of 150. This was a rough summary of how to use the ICT Judas swing. I hope it all made sense. If it did not make sense, please be sure to comment, ask your questions. I'll be there responding to all the questions in the comments. And if you want another video where we go over this live, I will be more than willing to do that.